You are listening to CEO Perspectives, a podcast by the Conference Board.
Welcome to this episode of CEO Perspectives, a signature series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of subjects that matter most to business leaders. To help make sense of these topics, we sit down with thought leaders and do what we do best at the Conference Board: provide trusted insights for what's ahead. I'm Steve Odland from the Conference Board and the host of this podcast series, and in today's conversation, we're going to examine the state of U.S. inflation. Will this never end? Joining me today is Erik Lundh, the Principal Economist here at the Conference Board. Erik, welcome.
Thanks for having me, Steve.
So, Erik, you do all the forecasting for the Conference Board for U.S. inflation, GDP, and so forth. What have been the latest in U.S. inflation readings?
Well, we've had a bit of a bumpy start to 2023. January actually saw an unexpected increase in the inflation rates. But last week, we just got in the February CPI numbers, and we saw a little bit of a reversal in that. On the top line, headline inflation, we saw it decelerate a little bit from a 0.5% in January, month over month, to 0.4%. But on the core front, we saw a little bit of an acceleration, actually. Core CPI rose to 0.5% month over month from 0.4% the month before. One of the big takeaways, I think, from the most recent print is that shelter prices, housing prices, have continued to be one of the primary drivers that we're seeing in inflation right now, in addition to some of the inflation drivers associated with the services sector. So, on the year-over-year rates, which is what the Fed targets, we're still well above the 2% Fed target. And it's going to take us quite a bit of time, I think, to get back down to something that's a little bit more acceptable to the folks at the Fed.
Okay, so you use a lot of terms in there, and we do have some real experts listening in. But for those listeners who are not expert at this, essentially, what I hear you saying is that inflation has slowed a little bit. You talked about core, and core is without food and energy, right?
Correct. Yeah. But
non-core is a little higher than core, meaning that food and energy are a little bit of an outsized contributor to it, right?
No, that's right. The Fed tries to strip out food and energy prices because they're quite volatile. So core is a way of looking at inflation without those two components. But the rates that we saw really peaked at the middle of last year or so. That was when inflation was at the hottest. We are seeing it cool down and slow, but as I mentioned, it remains well above where it should be.
Yeah, and so but it sounds like food and energy and housing are critical components, and not that everything else isn't also inflating, but those are some of the big drivers. Am I hearing you right?
They have been, and it's varied over time. One of the really interesting things about the inflation story that we've been grappling with as a country over the last year and a half or so is that we've seen different drivers sort of push inflation higher over time. It's been really an evolving story. So right now, housing is a big part of it. Some of the services, food and energy, maybe a little bit less so than they were at the beginning of the year, really last year. But it's really been an evolving story.
Yeah, but because core is lower than non-core, it suggests that food and energy, which is left out of core, is actually contributing, a great deal here. So let's just drill down on some of these. So what is your outlook for food prices, energy prices, and housing going forward over the next year?
So on the housing front, as I mentioned, about 70% of the inflation that we saw in February was associated with housing. So it's really taken an outsized role in the most recent inflation data. The good news is that we have been seeing rent prices, for instance, come down quite a bit, according to some of the private sector data that tracks rents, places like Zillow and other specialty kind of businesses. Unfortunately, rents, typically are locked into year-long leases, right? So it takes time for new rent prices to be fully incorporated into all of the leases as they roll over on an annual basis. So, Powell has said that we are seeing a relief on the housing front. It's in the pipeline. but it really hasn't sort of manifested itself in the inflation data quite yet. On food prices, we continue to see a disruption sort of reverberating from the war in Ukraine. That part of the world produces a lot of grain. Also, we've had issues with the disease in the poultry sector. That having been said, the rate of food price increases has cooled down a little bit, and we're hopeful that it continues to in the future. And then on energy prices, that's another really volatile story as well. We saw a big spike in energy prices associated with the invasion of Ukraine by Russia. Russia, of course, is a very large producer of a lot of energy, and some of the sanctions that were put on it a limited sort of global supply. So we have seen that cool off as well. But given just the amount of volatility geopolitically in that part of the world, we really could see it move in a number of directions moving forward, depending on, what happens in that part of the world.
Yeah, and we think of energy as typically, gas prices and how much it costs to fill our tank, but energy, oil prices in particular, really impact a huge swath of the economy because you've got energy and oil going into the development of fertilizers for food. You have it going into all plastics, which impact packaging for food and other products, and then also everything that's manufactured with plastics. So energy is a broad term, but it really has some broad implications.
And transportation prices as well. If it costs more to move a good from point A to point B, then that's going to be factored into the final prices that consumers have to pay at the register when they go shopping.
Yeah. So a little bit of collinearity with that. So as you look at it now, because, this has been going on for well over a year, what are the key causes right now? I mean, you've talked about some of the components, but do you see it mostly supply-driven or demand-driven or both?
I mean, it's been supply-driven and demand-driven at various points over the last 18 months. Right now, I still think that demand plays an outsized role. U.S. consumers are still spending despite higher interest rates, despite the higher prices that they've been seeing. There's still pent-up demand for a lot of services. So over the last year, U.S. consumers spent a lot more on goods than they typically did because they've been on lockdown or they're concerned about getting COVID-19. And so they're really kind of playing catch-up in terms of spending on services. At the same time, there is a supply component to that because of the tightness that we're seeing in the U.S. labor market. We had a lot of baby boomers retire. We had a lot of people drop out of the workforce. And in-person services sectors are having a really hard time keeping people and hiring new people to sort of meet this elevated demand. And as a function of that, they're having to raise prices. So you're seeing sort of a supply and demand sort of drivers pushing up prices for services.
Roughly even balance, do you think?
It's hard to say. I really think that the labor market tightness that's being sort of felt most acutely in in-person services is really problematic in terms of prices in that sector right now.
And that would be supply driven. There were also the whole set of supply chain issues. We shut down globally almost the economies around the world due to COVID. Restarting those supply chains has proven to be really challenging and lumpy. So you still have a little bit of that still going on, don't you?
You do. I mean, a lot of the biggest, it's not nearly as large of a factor as it was, say, a year ago, but it hasn't completely sort of healed over.
And then on the demand side, the people were saying, well, demand was being driven, as you said, by goods originally because we were all in lockdown, but a lot of government payments and so forth. So there was a lot of money out there, but I think that's been sort of worked off, isn't it? So are consumers relying more on credit these days?
They have been. The data have shown that revolving credit, so things like credit card balances and things like that have been going up. So consumers have been leaning more on those kinds of ways of financing their purchases. But, there's also been some work done, including here at the Conference Board, internally at least, looking at how much of that excess pandemic savings is still out there. And while it has come down quite a bit, consumers still have a bit of a war chest built up from the kind of stimulus that they received in the 2022-2021 period.
Well, so let's talk about the stimulus, because government spending has just skyrocketed. We used to spend, the federal budget used to be around $4 trillion. The latest budget submitted was $6.9 trillion, but we spent well over $6 trillion when you add in all the stimulus during this period of time. What role does stimulus and government spending play in inflation?
So, I think in terms of mounting government debt, I don't think that is contributing to inflation, but it's what that debt financed that has sort of been more of a contributing factor. So as consumers and businesses received support from the government to shore up their balance sheets or their household financing, it put them in a position where they could continue to spend and were willing to spend because they felt confident that they were going to be taken care of. But at the same time, you've also had some really a large infrastructure investment packages passed over the last year or so. That I don't think has yet played a really pronounced role in inflation. There is going to be a lot of spending that's done on building bridges and rebuilding airports and things like that, but it's spent out slowly. So I think that the drivers in terms of demand for commodities and workers to build these things is going to really play out over a longer period of time, which actually may make it more difficult for the Fed to get down to 2%, as there's that sort of lagged impact from some of these big investment programs that the government approved.
Well, you talked about debt, but I probably ought to separate those two for our listeners. There's the cash out, the big government stimulus that put you mentioned it before, put all this money in consumers' pocketbooks in companies. By the way, a lot of all the small business loans and so forth. So a lot of money went out into the marketplace. So you had that playing. Of course, they paid for it through debt. So they're kind of two different dynamics, right? And how should we think about the impact of both of those dynamics on inflation?
Well, I mean, I think what the government did is they sort of borrowed against the future to finance spending now. So it's created a wave of inflation associated with the programs that you just mentioned. But looking forward, it could actually be a drag in terms of the government's ability to spend in the future, because a larger share of their revenues are going to have to go into servicing that debt.
Right, and then as you cycle it, a year later, you don't have the same level of spending out there, which is part of the debate that's going on in Washington, of course. But that brings back to the point, when inflation first started, popping here, the government started saying, well, it's all transitory, meaning it's short term, it's going to be over really quick. But that hasn't been the case. You've touched on a couple of points on why, but just why does it continue to linger? Just go through the whole series of reasons.
Sure. Well, I mean, as we touched on earlier on, the drivers at first had a lot to do with disruptions in supply chains associated with the pandemic, factories shutting down in China, the U.S. not being able to get enough workers to provide, things to consumers. And then as those kinds of supply chain bottlenecks started to unwind themselves, we had additional shocks that weren't expected come into play. The war in Ukraine was a very big one, which sent energy prices higher, food prices higher. And so that was sort of another wave of inflation that came to, that wasn't expected. And then on top of all that, you've had these labor market dynamics as well, which has been pushing wages up higher, increasing costs for companies that have then passed those costs on to consumers. So I think, when the pandemic, initially was unfolding, the thinking was it would be transitory inflation because the supply chain bottlenecks would resolve themselves. But since that time, we've had a variety of other factors sort of spill out of it that have kept that, those price increases rising very rapidly.
Yeah, so you still have some of the supply chain issues. You then have some shortages. You have the increased demand. So all of the things you've talked about have extended this, and probably will continue to extend it going forward into next year.
Yeah, certainly the labor market dynamics, I think, are a really important factor to take into consideration because we don't project to see any real softness in the labor market anytime soon.
We're talking about what's going on with U.S. inflation. We're going to come back and talk a little bit more about what the Fed will do and what the banking crisis impact will be. We're going to take a short break and we'll be right back.
As you and your company monitor the volatile and uncertain economy, the award-winning forecast team at the Conference Board predicts a downturn by the end of 2022. Recession will further compound the crises that have recently upended expectations, from a deadly pandemic to a war in Ukraine and the highest inflation in decades. Yet, unprecedented crises also present unforeseen opportunities if you have a trusted, proven navigator by your side. With that in mind, and as the Conference Board has always done, we are providing you with daily, timely, and relevant content that will guide the business community through the economic storm. These trusted insights are being gathered on our website and are available to help your company master the challenges. To find out how you can chart a course for the future which will allow your business to emerge stronger on the other side, visit our free economic hub entitled Navigating the Economic Storm, your indispensable guide through the global recession, located at conference-board.org/topics/recession.
Welcome back to CEO Perspectives. I'm your host, Steve Odland from the Conference Board, and I'm joined today by Erik Lundh, the Principal Economist here at the Conference Board. And Erik, we were talking before the break about, all the government actions on this. The Fed has been playing a bit of catch up here because, initially thinking it was that inflation was transitory. They didn't take a real aggressive approach to it. And then when it became clear that it was a little stickier than that, they began to get more aggressive. So what is our projection of further Fed actions?
So you're right, Steve. The Fed was a little late to the game. That having been said, in 2022, they really ramped up interest rates really, really rapidly. And so we've seen a 75 basis point hike sort of meeting after meeting. It has slowed down to 50, now to 25. Looking ahead, we're expecting later this week to get about a 25 basis point hike. Then we're expecting 2 more 25 basis point hikes in the second quarter of this year. Further afield, we expect the Fed to pause after that. So we're getting the Fed funds rate up to right around 5.25, 5.5%. We don't think we're going to see a cut until probably sometime in Q2 of 2024. So these rates are going to be with us for quite some time. And then hopefully as the inflation dynamics cool further, we'll start to see those rates step down a little bit over the course of 2024.
So when do you see us hitting the Fed target of 2% inflation in the U.S.?
That's going to be a longer-term goal. It's not going to be something that's achieved quickly. Our projections right now is that we'll see year-over-year inflation rates hopefully dip down to maybe about 3% by the end of 2023. But we're really not expecting to see something close to the Fed's 2% target until the end of 2024.
So we've got 18 to 20 months more of this to go. Now, what happens then if, so obviously the Fed's thinking, there's got to be a transition down to 2%. What happens if they're not seeing it? And, do you think they're willing to go higher with the discount rate, 6%, maybe even more?
I think they could be. I mean, Powell has said as much that they're willing to do whatever it takes to get inflation under control. So, the prospect of 6% is feasible if inflation doesn't come down or if it, reverses because of additional shocks.
No, we haven't seen these kind of Fed discount rates for quite some time, have we?
No, we haven't. It's been a pretty long period of time.
Yeah, and what back in the bad old days of the early 80s when we were really fighting some really sticky bad long-term inflation. I mean, these discount rates got high single digits, low double digits.
Yeah.
So I mean, it's not unprecedented, is my point, that they're willing to go as high as necessary, right?
No, I mean, during the 80s, we saw extremely high interest rates to try to get a handle on inflation, and we're nowhere near that yet. But certainly, we've demonstrated historically that we have been willing to make that kind of sacrifice.
Yeah. Okay, so let's just say they do go beyond 5%. What are the ramifications elsewhere through the economy? How does that ripple through?
So, I mean, our projections are that we're going to pierce 5% over the next couple of months. That the Fed, if it needs to, will go even higher. But even given our forecast of a Fed funds window of 5.25 to 5%, what we are forecasting is that the U.S. economy is going to slip into a recession. We're expecting to see negative GDP growth in Q2, Q3, and Q4 of this year. Fortunately, we're not projecting at present a deep and prolonged recession. So it's something on the milder side, but certainly businesses and consumers are going to eventually buckle under the weight of these higher interest rates, and it's going to result in a recession in the U.S.
Yeah, and those interest rates, well, it's the Fed controls what's called the discount rate, which then translates into higher interest rates because banks can't borrow from the Fed window at the same level, so they charge more. So this hits really the entire economy. I mean, your credit card costs go up, interest rates on consumer debt. You have mortgage rates go up. You've got business borrowing goes up. So it really raises the cost of all debt, doesn't it?
It does. The cost of capital rises, and it hits everybody who borrows. And it's already hit sort of the more interest rate sensitive parts of the economy. You mentioned mortgage rates. Those have gone up quite a bit from where they were even a year ago. And as a function of that, we've seen cooling in terms of the housing market. Residential investment has already been contracting for a number of quarters now. We're expecting to see consumers spend less on vehicles, on interest rate sensitive goods and services, and then on the business side of things, of course, as the cost of borrowing increases, it makes businesses less likely to invest. So fewer purchases of capex, factories or equipment, things like that, and that cools demand for the economy as well.
Yeah, and this is the point of the Fed taking these actions, is to try to slow everything down a little bit, get back to sort of a normalized 2% rate. And it's interesting because, a lot of the discussions with the Fed and between the Fed and Congress has been about, how do you balance the pain? Where are you willing to take it? Is it so important that we get to 2% inflation that you would rather have, 1 million or 2 more people unemployed? These are tough kinds of decisions that they're making, right?
They're very tough decisions, and Powell has said that, he is willing to make some sacrifices to achieve that. I think the view at the Fed is rightfully so that the current level of inflation is unacceptable. And if it requires making some short-term sacrifices to get it under control, then the Fed is going to be willing to do that.
One of the things that people weren't thinking about it, and they certainly weren't talking about, is the increase in interest rates impact on bank balance sheets. I guess all balance sheets, but bank balance sheets, because, banks have been taking customers' deposits and investing them in long-term safe treasury securities, but they're safe, but they do fluctuate in their value if the current government debt is being issued at higher rates. That's more valuable because it pays out more. So those bonds that they bought then declined in value, which is causing then bank balance sheet issues. So these are all kind of wrapped into the unintended consequences, right?
No, that's absolutely right, Steve. I think you really hit the nail on the head there. Banks have seen their assets depreciate in value as interest rates have risen. A lot of the banks are required to mark them to market, right? So there's been a little bit of a misunderstanding, I think, in terms of how much they've been impacted. But as consumers, especially depositors, have seen these issues play out, they've gotten concerned about some of the banks in terms of how well capitalized they are. And that was exactly what we saw in the case of the bank run that happened at Silicon Valley Bank. We saw a massive exodus of deposits, which ultimately pushed the bank under. So there's a whole new dimension to sort of the inflation, interest rate / now financial stability story that's sort of developing.
Yeah, and bank capital is not the same as bank cash. And so I think, what happened is people saw that they were trying to raise money to shore up the capital. And then they started doing withdrawals, which required cash. And then they had to, so these banks essentially mark to market by selling at the current valuations and taking these big losses in order to meet the cash needs. So you've got this double whammy that's happening. So then the question, Erik, is what happens if the Fed does go up to, we're not even to 5%. What if it goes up to 6 or beyond? Does it create even more stress on banks?
It does. As interest rates go higher, the value of the assets that the bank already hold in terms of debt, becomes further eroded, which can create even more alarm among the public in terms of the stability of the banks. So you could see even more sort of flight of deposits from smaller and medium-sized banks to really large ones that they feel more confident about.
Right. So all of these things have to be playing into the thought process here of the Fed, right?
So, the Fed has a couple of mandates. Maximizing employment is one, creating sort of a sustainable inflation environment of around 2% is another. A third is ensuring financial stability. Unfortunately, it appears that the financial stability concerns are rising, which puts pressure on the Fed in terms of its ability to further raise interest rates to quell inflation. So all these different mandates are sort of getting mixed up right now, and it's put them in a bit of a pickle in terms of how to proceed.
Yeah, I'm sure. You said earlier that they didn't move fast enough. I'm sure now with perfect hindsight, they probably are saying, "Gosh, we should have moved faster earlier." But you can't change history, so therefore they can only go forward here and try to deal with a very, as you described, a very tough situation. So we're not criticizing the Fed or anybody. It just is what it is at this point. Now they are dealing with two levers here, Erik, which is interesting because historically they've only used the discount rate as their sole lever, but you also have what's called quantitative tightening. We're working off their balance sheet here, which is the reverse of quantitative easing that they had during these crises. Talk about the impact of that.
So we saw a huge increase in the size of the Fed's balance sheet over the last couple of years as the Fed engaged in quantitative easing. It swelled to about $9 trillion, but starting at the beginning of last year, they began to lower or reduce, that is to say, the size of their balance sheet by letting some of those treasuries and mortgage-backed securities sort of gradually fall off of their balance sheet over time. The plan that they implemented last May hasn't been changed. It continues to play out on a month-over-month basis. And the net effect of that is, according to some of the reports that we're watching, accounts for about an additional 25 basis point hike in terms of interest rates. So it does have a factor in terms of continuing to slow the economy and raise interest rates.
So just to wrap up, maybe you could just tick off some of the effects of inflation throughout the economy.
Well, there's a wide a variety of effects. On the one hand, you see this sort of act as a sort of regressive taxes. Prices are rising across the board, but it's impacting lower income households, I think, more than upper income households. Lower income households, of course, have fewer sort of financial resources to lean against as prices for food and for gasoline go up. And so it's hitting them harder than people in those upper income brackets. Also, the higher cost of capital, which we've already mentioned. Businesses are having to pay more to borrow. Consumers are having to pay more to borrow. So we're seeing that play out. The bond prices that we already talked about in terms of those being hit by the higher interest rates, that's having reverberations in the banking sector, as we've already seen. And really, even stock prices are taking a hit now as investors are able to put their money in higher interest rate kinds of investments. It pulls money out of stock markets and hits their prices.
Yeah, it really is very impactful and it hurts all the way across. Well, your crystal ball says that by the end of 24, we should be somewhat back to normal, and hopefully not too many things will break in the meantime. And I guess that's the best we can do is hope on this, because there's no two situations that are alike, and we haven't seen exactly this one before. Erik, thanks so much for joining us today.
It's my pleasure, Steve.
And thanks to all of you for listening in to CEO Perspectives. Every week, I'll be joined by a prominent thought leader to provide insights on the issues of our time. We'll cover the leading topics in geopolitics, economics, public policy, ESG, and more. Please share CEO Perspectives with your colleagues. I know they're going to want to listen. I'm Steve Odland, and this podcast has been brought to you by the Conference Board.
You have been listening to CEO Perspectives, a podcast by the Conference Board.